we have to recognize the fact you're a private company and it's very time consuming and costly to exit ownership. We've got to take a discount for lack of marketability of 15, 20%, 25% off of your valuation. And many owners don't think about that. But if you have a professional valuation person to conduct a private company valuation, they're going to layer that in. So for you folks in the room that own private companies, realize that there is, in most cases, a discount on your value because it's not easy to exit ownership.
What is the typical premium for control premium?
For, okay, back here, control premium, 30%. Okay, and I'm going to give you some ranges here of these.
Is it 10% discount on that liquidity marketability low?
10% would be pretty low. Yes. Okay. We call that DLOM. Everything's got an acronym. Customer concentration discount. If your company has, your company that you're looking to purchase has heavy customer concentration, we should apply versus the comp set. Again, we're only thinking about the trading and transaction methods. The liquidity can apply to all three methods, trading, transaction, and DCF. And this is the only discount that would apply to the DCF method most of the time. Now, customer concentration, you're comparing customer concentration of the subject company you're valuing to the comp set group. Often you're not going to know the customer concentration of transaction comps. There's no way to find, unless that company was a public company that was sold to a public company, are you going to be able to identify that. But for publicly traded companies, you should be able to go into the SEC filings and see if they had customer concentration. And if that is the case, if the trading comps have a lot of customer concentration and the subject company does not, then you can get a premium, and vice versa. If the company you're valuing has heavy customer concentration but the comps do not, you need to take a discount. This I usually max out at 10%. Okay? Yes.
Yeah, I'm just not sure I understand why that concentration, customer concentration.
Pose a risk?
Is that because they're assuming that sales per customer would be lower?
Well, if you lost your
So
If you lose your big
remember
customer.
my story yesterday? We took a company into the market. This guy right here actually looked at it. Marty Harrison. He looked at the company that I gave the story about. I gave the story about what we call Project ICE, which was back in 2003. This is a company that was a radiator, made radiators, high performance radiators for cars. And one of their biggest clients was Harley Davidson. They actually made radiators for motorcycles too. Well, guess what? In the middle of the deal, Harley Davidson went away. They took their business elsewhere. And that one client made up, I think, about 30 to 35% of the total revenues annually for our client. So when that went away, the value dropped. So as we valued it, as we were trying to determine what's the value of this company before we take it in the market, we need to give our client good advice. And guess what? We need to discount your value because you've got one client that makes up 30% of your business. Therefore, we need to adjust downward your valuation. Because it actually happens. I mean, it's painful for me. It was very painful to have to take this. I mean, we worked really hard and then this happened and we had to take it off the market. Makes sense?
Mm-hmm.
What's high customer concentration? What would you guess? What would you say high customer concentration?
20%.
Yeah, I'd say if one customer makes up 20, 25, 30%, you definitely want to see a discount. You can also look at top 10 customers. If the top 10 is 40, 50% of the business, maybe a small customer discount is applicable. Okay? The final is small company discount. If we're valuing a company that's much smaller than the comp set, either trading or transactions, okay? The public companies are billion-dollar companies. When we're valuing a $10 million company, I'm going to apply a small company discount. Well, because they're worth less, they're more risky. They have more risks to them.
And do you have a dollar amount that you would ascribe to?
10% typically is the max I would take. So between the customer concentration and the small company, if both existed, I would max that out at 20%.
Do you have a number in terms of revenues of a small company? Is it 10 million, 20 million, 50 million?
What's the book that we go to?
You talking about the Ibbotson?
But Ibbotson no longer, it's
Oh, it's
Standard & Poor's, or there's a book that has
It's,
ranges for
For
this.
industries?
Yes.
yeah.
And it used to be Ibbotson, and now another Morningstar or somebody like that, S&P took it over.
Yeah, it used to be Ibbotson. It's
It's nice, and then they publish an annual book. And I can get that name.
not a cheap book.
So those together, so here we talked about several, we're applying these again to the trading, the transaction, and for the discount for lack of marketability, also the DCF. But here are kind of maxing out what these could be. Plus or minus 30% for control premium minority discount, 20% max for small company and customer concentration, and DLOM or liquidity discount can max out at 30%. So you really can cut, valuation can be cut. And this is something that's really important for you because these owners of companies are probably not thinking this way. But this is how professionals, if you had a professional value a target, they're going to use this to reduce the value. So you can overshoot or overbid if you're not applying this. Okay? I think we're now to, so this is the final, and I made a mistake here on that upper end of the terminal value of the comp approach we just did. So this is the DC, which is the DCF. This is the DCF range we came up with based on that range of WAC. And here's the trading method. So here, this is telling you, kind of stepping back, big picture, okay, the trading is telling you that the market, you're not seeing any overlap between these two methods, which for me, that tells me, because we're using the trading approach, that stocks are trading at a high. Okay, so this method is coming out high, the DCF is coming out much lower. I wish we had a transaction method that showed up to kind of indicate where that would be, but we don't have that in the case. So what we do here is, this is a really important final exercise we do. We call it dropping of the bars or confluence range. You put the ranges down on top of each other. Here you've got the enterprise value as the x-axis, and the two methods, this is trading, this is DCF. What does this mean visually to you? What do you conclude the value should be for Mercury? I would conclude, this is subjective, very subjective, and it's something you discuss and you reach a conclusion. You want to look at this in relationship with, okay, we drop the bars, we're dropping the bars between these two methods. We're coming up with a value range of 364 to 397. Okay, this is post discounts. We didn't actually apply discounts here, but if we did, let's assume it's post discounting or premiums. And what is this as a multiple of trailing 12 months EBITDA? Can anybody quickly calculate that? Or what is this as a multiple of trailing 12 months revenues? This is actually what you're going to communicate when you make your offer. You've done all this work on DCF and other methods, but it helps you reach this conclusion, and now you're going to take that conclusion, and I'd probably take the midpoint and now say, I'm willing to pay a multiple of X off of your EBITDA. One other, let me think here. One other thing I wanted to mention is, what weighting do you give these methods? And this goes back to our conversation this morning. One final step to make, which we are assuming we just made it, there's no adjustment here for, we haven't weighted the methods. Do I want to weight the DCF method 50% of the value and the trading method 50%? Or do I want to weight the DCF method 75% and the trading method 25%? Maybe I don't like the comps of the trading method, therefore I'm going to weight the DCF method much higher. And that maybe I'm more comfortable with the assumptions of the DCF method, so I'm going to weight this method more. That's going to move these bars.
Is it going to depend on which side of the deal you're on? If you're selling, you're going to try to get that enterprise value up as high as possible. So wouldn't you weight the one that gives you the higher, when you present your offer, wouldn't you just concentrate on the one that gives you the higher value?
Like, for example, the deal that hopefully is closing as we speak. We're watching our email. When we did that, we had to know that, okay, buyers are going to do the same exercise. So we had to make judgment calls based on what we were we're representing the seller, and yet we had a trading method, we had a transaction method, and we had a DCF method. I think we weighted each method a third, because we were comfortable with the comps for both the trading and transaction. There were recent transaction comps. The trading comps were pretty good. I mean, the overlap was not great, but the comps, represented what's happening in the industry. And the DCF method, we actually helped them create. So we were pretty confident with the buildup of that method. And so in that case, we're creating a range, and the range is, we want to go for the upper end of the range. That's our goal. But through those methods, that midpoint, you then create a range off that.
So you're shooting for the higher end, but
We're
you
shooting
know
for the
where
higher
your
end.
range should be.
So that 33, 33, 33 gives you a point, a median, and you create a range off that, and that's where you're going for the higher end for your client.
Gotcha.
So if I'm a buyer in this context, and it's my DCF, I feel confident this is what I truly believe this company's worth, why would I offer to pay more just because the market's higher? Wouldn't I say, it's probably not a company?
You're saying, why would you pay up here if it's down here? If you're really comfortable,
Yeah,
then
I
do
like
it.
to see
I say that if this weighting should be like 90% 10,
Well, I guess, why would I put any on the market? I understand the market's very relevant to tell me what deals are doing, and
yeah.
am I even a player? in
If
this?
if you don't believe the market at all, like it's too high, remember though, you're buying a company in a market condition, and the market of the sale of companies does reflect where prices are, just like any other markets. You can't totally ignore where market prices are.
But doesn't cyclicality play in? So if you're maturing in that cycle, and you've got all this recent data that supports a price, but you know you're in the mature phase, wouldn't that factor in to his point?
It should factor into the public comps too, if you've got good comps.
I guess what I'm
If you're in a mature industry.
If I'm investing, I understand if you're, say, private equity, you've got a time on the buy, you're only going to sell it for 4 years, the market price becomes very, very relevant. But I'm going to buy, I'm just going to hold this company, I'm holding it forever. How am I expecting to get the value out of it? And I understand you say, well, the reason we do it would be because maybe in 5 years, the market price is even higher and we can sell it. But if you're talking about, I'm just looking at the value of the cash flow that's going to return to me, unless I don't have confidence in my, why would I pay more than that just because the market is paying?
Well, it's what valuation professionals say is triangulating is really important in valuation. Triangulating means you're coming up with a DCF value, which is a certain method, but you always want to look at other methods and you want to triangulate. You still have that judgment call as to weighting these methods differently. And that's subjective, and it's your call how you weight them. But triangulating is the way to go, meaning you want to have several, ideally you want to have 2 to 3 different valuation methods that you're running, and you're letting these settle, and you're looking at all of them together on one sheet of paper, and you're deciding, what does this mean for me? And you've got to make subjective calls. And it may mean that you really are rejecting. Sometimes we have rejected other methods, and we've said, this is way off the map, and it doesn't make sense. We're going to weight this method 80%, and hopefully we have another transaction method that we weight 20%. But we really don't like valuing a company on one method alone. Now,
There's a difference
unsophisticated.
in valuing the company for your own team's purposes and what it'll offer you. That is not necessarily the same thing.
Oh, no, I'm saying, if you're a buyer, and sellers completely different. We go
What if you're wrong?
Yes.
Sell the market's good. But if you're a buyer, it's the opposite. You buy when you get something at a bargain. And my point is, if your process of looking at acquisitions is, I'm going valuing them, why wouldn't you wait till you find one that is priced, led to where you value it as opposed to, I value it here, but the price is higher, but I just do it here.
You're bringing up a really valid point that all of you live in, and you will be living in doing this, is that the markets are efficient. There's typically, you may be facing competition for this acquisition, and when somebody else is factoring in market prices and you don't, maybe just don't win the deal. And it's time to move on to the next deal, and then, you live and learn, and you get to the next deal, and if you don't win that one, you keep going. You've got to face the market realities of other people. Are, if it's a good company, and it's in a good industry, and it's got good market conditions, you want to be a hunter. You want to, like I said yesterday, you want to be one-on-one, and there's no other party. But the reality is, once you do approach them and it's exclusively a conversation, they may say, well, who else is out there? And let's go talk to an investment banker, and let's see what the market, the auction process drives prices up.
There's also times when it flips, right, when the DCF will show.
Yes,
We're right
definitely.
now in a time when the market is very high.
Yes, this won't always be the case. But what I want to impress on you for the fundamentals, all of you, is that you want to triangulate, you want to use several different methods. I've taught you the hardest method to learn. These are the easy methods. You want to use several methods. You want to triangulate and then decide, what does this mean for me? And what does it mean for our ROI? I mean, I haven't talked a lot today about ROI, but it's the main theme of this whole conference is how do you capture ROI? If you can't get there, the best decision is don't do it. I mean, really don't overpay if you can't capture and create return on investment. Now, in some cases, you may be sacrificing ROI to Tom, you brought up scale is so important, and you've got to sacrifice ROI for scale. That's unique to you, and that's a real valid point. So everybody's got different issues they've got to judge and prioritize. But all really good points, really good points. I've got one more wrinkle before we stop and move to synergies. We'll take a break. The WACC, so again, we just valued this company, Mercury, as a standalone company, right? But in the case of, they actually said 20%. The company didn't have any debt, but John Litkey assumed 20%. And I read into that was the capital structure post-transaction. And that's exactly what you need to do. When you're evaluating a company for an acquisition, you should value it standalone, but then you need to value it as if you own it. And then add in synergies, because that's going to affect, you're going to revise some of these assumptions of cash flow and revenues and costs, but what are you doing with it? How can you create synergies? And that's going to be the rest of today is thinking about that. But we just want to touch on WACC in that concept one point. And the WACC equation needs to adjust in light of that, for you acquiring this company, and this is in your printout, but this is how the WACC adjusts for you owning that target. So up here is the debt side. The debt percentage is the debt to capital after the transaction. Okay? So let's say you layer in debt to make the purchase and you're leveraging up this target and the company as a whole. You want to reflect the capital, the WACC, as the debt after the transaction is done. Okay? Same as equity down here. Here's the equity component. You're adjusting for what's the debt as a percent of capital and what's the equity percentage of capital after the deal is done. The same here, you're taking the tax rate of the target firm, same as before. The cost of debt is the cost of the debt after the deal's done. Okay? But the cost of equity is still the target's equity. You don't adjust the target's cap in or cost of equity for you because you now own this company. You keep it with the target. And that is an important adjustment you want to make when you run that next layer of scenario of DCF, okay? Real important, and that's going to change the valuation. Just think that WACC has a large influence on valuation. So with that,
Are you saying to do this kind of sensitivity? I know you're doing it after just to see.
we say you should do it no matter what. I mean, not just, you're valuing the company. We just value, up until right now, we value the company standalone. But we need to value it as if you own it, okay? What is it, the value, how does the value change once you own it? Which means you're going to adjust cash flows as if you own it, which includes synergies, and that's, we're going to talk about that.
So with that new value you get, are you just using it as another flag you're putting in the ground? If I owned it, this would be the value, but I might offer this value, but is it all you're using it for?
You're using it for the negotiation, yeah, but you're also using it for going forward. Once you own it, that's now the value. So you need to make this adjustment, real important, that you think that through. So with that, we're up to synergies, and that's the balance of the day. Let's take a break. We want to take a 15-minute break, and then we'll wrap up with synergies for the balance of the day.